An RVOL value between 1.5 and 2.0 produces a 58.8%, so nearly 60% 3-day follow-through rate. An RVOL above 2.0, only 43.8% next-day follow-through. In this video, I'll share the results of our backtest in which we looked at more than 1,872 different breakout events across 50 different S&P 500 stocks to find out which volume levels actually helped predict winning trades. The answer, I think, contradicts what is the baseline belief that a lot of us traders go into trading assuming based on what a lot of these quote-unquote gurus tell us. Now, first off, let's talk about why volume separates winners from losers. Volume is the fuel behind every price move. A breakout above resistance on, say, 3 times the average volume has statistically a higher chance of following through than one on less than average activity, or less than average volume activity. Now, this applies across all of the different time frames and instruments almost broadly as a general rule that people will tell you. Raw volume bars also tell you how many shares are traded, but what they don't tell you is how significant is that number. For example, 10 million shares could be 3 times the average volume for one stock, whereas for another stock, it's only 0.5x the actual average. So that context gap there is why you need different volume indicators. And in this video, I'll show you 3 different volume indicators that I think help give you the complete picture, and all 3 are free and built inside of ThinkorSwim. Now, the first one is relative volume. That tells you if your current volume activity is quote unquote unusual. The second indicator is the volume weighted average price, VWAP, which tells you whether institutions, or rather where institutions, are positioned. And finally, 3 is the OBV, which stands for on balance volume, and that reveals whether money is flowing in or out over time. I think if you have these 3 indicators, you get a lot of the complete picture, which, based off of our data, gives you an actual edge, which a lot of traders are missing. Now, to give you some context, the RVOL sweet spot of this 1.5 to 2.0, why that? To help give you that context, we ran a backtest across nearly 50 S&P 500 stocks, not nearly, 50 S&P 500 stocks, from March of 2024 to March of 2026. So about 2 years worth of data, and we defined a breakout as a close above the 20-day high. Now we've tracked forward returns from this breakout at both 1-day, 3-day, and 5-day intervals. Using all of that, here's what the data shows us. An RVOL below 0.5 produced only 40% 5-day follow through across 15 breakouts. Thin conditions, not really tradable, doesn't give you any concrete edge. An RVOL between 0.8 and 1.5 is the normal range. Looking at 1,216 breakouts, 53.3% of them had this 5-day follow-through with an average return of plus 0.26%. It's workable, but still, again, plus 0.26%, not really any kind of meaningful edge. Now you look at an RVOL between 1.5 and 2.0. Here you have 220 breakouts, 58.8% 3-day follow-through, highest of any bucket, plus 0.76% average 5-day return, nearly 3 times the normal range, and it feels like RVOL above 2.0, you would expect this to get even better. However, here we had 176 breakouts, but that next day follow-through drops to 43.8%. So it seems like these extreme spikes often mark short-term exhaustion before continuation in trends. Now, why does this extreme volume above 2.0 underperform? That was something that really threw me off guard, so I started to dive a little bit deeper into it. This was the quote-unquote counterintuitive finding where I think you'll see a general rule of thumb most traders say is RVOL above 2.0. No, it's actually between this range that we talk about. An RVOL above 2.0 should mean conviction. It should signal all of the strong institutional interest, everything everyone tells you, clear directional bias, blah, blah, blah. But the actual data shows you something completely opposite. What it shows you is that only 43.8% next day follow through compared to the much higher percent and nearly 11 points higher, 54.8% for the 1.5 to 2.0 range. So the range is a sweet spot. Above 2.0, not so much. By day 5, the numbers converge to 53.4%, which is still below that sweet spot. So what explains this? I was trying to dig a little bit deeper, and I think the answer is volume exhaustion. When a stock gaps up on about 3 or 4x the average volume, much of the buying demand gets absorbed almost immediately. The easy money is made in that first few hours where you have the momentum trades. Latecomers after that, the FOMO, you usually get trapped. Now, this 1.5 to 2.0 range represents this period of elevated conviction without the exhaustion component. It's enough volume to confirm the move, but it's not so much that the move is already over. I thought that was very interesting. One of the biggest takeaways, if you will, from this entire experiment. Now, next up, we looked at the volume weighted average price. This, across the board, you could almost call it the institutional benchmark. Now, the volume weighted average price is the average price a stock gets traded at throughout the session, weighted by volume at each level. It represents the true average cost basis for all shares traded that day. Institutional traders use VWAP as a benchmark for their order execution. So, say for example, a fund manager buying 500,000 shares considers the execution quote unquote successful if they achieve a price at or below this VWAP price. They got a better deal. This creates natural support and resistance around the VWAP line as well. When price trades above the VWAP, buyers from earlier in the session are generally profitable on average. This creates a psychological floor, and when price drops below the VWAP, those same buyers are underwater. That increases the selling pressure, and then you might see a move to the other side. Now, VWAP works best during the first few hours of the trading session when volume concentration is highest. You'll see that even inside of the volume graphs. As the day progresses, the VWAP becomes, in my opinion, less responsive to new price action. Now, the standard VWAP shows you just a single line. However, by simply adding some standard deviation bands, you can transform the VWAP into a mean reversion tool. And this is not, I don't think it's built inside of ThinkorSwim, but it takes just a few simple lines of code to do this. Now, price touching, say, the second standard deviation band above the VWAP would indicate an extended move to the upside. So mean reversion traders there, you'd be looking for exhaustion signals at these prices, something like a bearish edge signal, for example, for all of our volatility box members, and then look for price to hold between the VWAP and the first upper band to suggest that this bullish momentum has been there without overextension. Now, in ThinkorSwim, if you study or search for the VWAP in the studies menu, you'll find that the VWAP is a built-in study. It also includes actually an option for the deviation bands, I stand corrected, and you can set this numDev parameter to both the first and second standard deviation levels to have this mean reversion sort of idea, so you have very clear notions of where you'd like to revert back to the mean. Now, the anchored VWAP, which we built as our very first ThinkorSwim tutorial, extends this concept across multiple days, which is where I find this useful, or even if you wanted to anchor at the beginning of a market session or overnight hours. Instead of resetting it, you can anchor it to some of these key dates, and you'll find that after, say, an earnings event, anchoring to that actual post-earnings volume move is where you find a lot of support moves coming back to, the anchored volume-weighted average price from that level. So that's a way to heighten up the VWAP as well. Finally, the third indicator we have is the OBV, the on-balance volume, which tracks the cumulative flow. On-balance volume adds volume on up days, and it subtracts volume on down days. This absolute number is meaningless. However, what does matter is the direction of the OBV line relative to price. A bullish divergence occurs when price makes lower lows, while OBV makes higher lows. This indicates accumulation happening beneath the surface. Money is flowing in despite falling prices, and a bearish divergence shows that price is making higher highs while OBV is making lower highs. So despite rising prices, volume is flowing out. This distribution pattern is frequently preceding of some of the more meaningful corrections and pullbacks. So two ways that you can use divergences to both help you with bullish and bearish moves, trying to get ahead of it. Now, OBV divergences often precede price reversals by days or weeks. So the key is then waiting for some sort of price confirmation, whether it be through just candlesticks if you're traditional that way, or indicators if you're like us and you like to have some sort of tool to help you figure out when to buy or sell. Now, the strongest setups occur when you combine multiple of these volume indicators. Hopefully, at this point, you figured out that each one serves a different purpose. Each one answers a different question as well with that different purpose. So, for example, relative volume answers the question, is the current activity significant? Now, based on everything we looked at from our data, we've learned that we want the RVOL value to be between 1.5 and 2.0, not greater than 2.0. Now, with the VWAP, the question we're trying to answer is where are institutions positioned? Breakouts above the VWAP have tailwinds from already profitable buyers, so you might see a little bit more momentum there. And finally, 3, the on-balance volume. Is money flowing in or out? A rising OBV confirms accumulation, and if you combine this with something like the market pulse, which has the accumulation market stage, you start to get a little bit more of a complete picture. Now here's the workflow for a breakout at say 10:30 a.m. Check the RVOL first. Is it at least 1.5x the 20-day average? Then if it is, check the VWAP second. Is price trading above it? And if it is, then check 3, the on-balance volume. Has this on-balance volume line been trending higher over recent sessions? When all 3 of these conditions confirm, then you have a volume-backed breakout and one that helps you actually participate in the right direction of the move. When one or more of these indicators conflict, that's when you have signs of either, say, reducing your position size, maybe waiting and just sticking around for the signals to align, or maybe just sitting out that setup altogether. Now, there's 4 mistakes that I think trap the traders who don't understand some of these volume nuances. The first mistake is ignoring the time of day. Volume concentrates in the first and last hours of the session. A 2.0 RVOL reading at 9:45 a.m. Eastern, 15 minutes after the market opens, carries a lot different implications and insights with it than that same reading at say 1:30 p.m. much later in the day after lunchtime has passed. Morning volume spikes are expected, so we need to account for some of that noise. Midday volume spikes, however, signal a little bit more unusual interest, and you need to be aware of the differences between the two. The second mistake, using raw volume instead of relative volume. Raw volume bars are, I think, quite useless for decision making. You need the context, which is where relative volume gives you the context of putting today's volume in perspective. Mistake number 3, expecting VWAP to work in all conditions. VWAP is most effective during trending days with clear directional bias. On choppy, range-bound days, price just whipsaws around the VWAP repeatedly, and using those mean reverting bands is a much better use of using the VWAP line. And finally, the 4th mistake, trading the on-balance volume divergences too early. Those divergences pop up, but they signal potential reversals, not immediate ones, as we've discovered. You need to wait for price confirmation and volume confirmation as well. It was only the 1.5 to 2.0 that had the immediate follow-through that we looked at. All of the data we talked about in today's video is available to all of our Volatility Box members in case you want to download the full CSV with all 1,872 breakout events. The data sheet is a CSV file, so if you did want to feed it into an LLM or whatnot, you can go ahead and do that. Otherwise, I hope you did find this video helpful. For those of you that like to use volume for your trading, I thought this was a fun experiment to use some data to figure out what actually works with volume. Oftentimes, I've seen clues and tricks that volume is played on a lot of traders. It's nice to have some real numbers. If you have some ideas for other experiments that we can run, maybe test some ideas, I'd love to hear from you. Leave a comment and I'll be sure to check them out. Take care, everyone. Good luck trading, and I'll see you in our next update.